Trust in financial services has been increasing. But with trust in technology companies decreasing and the pandemic accelerating the shift to digital financial services, it's more important than ever to actively build and maintain trust. In association with MyTech, we've launched a report that explores the current trust issues facing financial services brands and how they can be overcome. Head to bit.ly/Digital Trust Report 2021 to download it now. From 11FS, this is FinTech Insider News. Today we bring you lots of funding rounds as Ramp joins the FinTech Unicorn Club with a new funding and valuation. Modular receives strategic investment from FIS Ventures, and the mortgage market is hotting up as SoftBank pumps $500 million into Better.com. All this and more on today's show. Welcome to episode 520 of FinTech Insider. I'm Sarah Kocianski from 11FS, and I'm joined by my colleague and co-host Simon Taylor. How are you doing, Simon?
I am excited. We have some great guests. There's all of the FinTech happening. How are you doing, Sarah?
I am good. And for those of you in the UK, this is Freedom Week. We've been released from lockdown, but I have to say I haven't been outside yet. So that's what I'm looking forward to this weekend. There's exciting FinTech news, but I'm also looking forward to, maybe going somewhere other than my front room for the first time in months.
The great outdoors, hey? It'll rain as soon as you get out. That's what happens.
Yeah, you're right. But to be honest with you, I've got umbrellas, I've got a waterproof coat. I'm ready for it. I'm British. I will do this. We are, of course, not alone. We are joined, albeit remotely, by some awesome guests. So first up, making a welcome return, we have Miles Stevenson, CEO at Modular. Welcome back to FinTech Insider. How are you?
Very good, thank you. Great to be back. Pleasure to join you again.
We've got some exciting news from Modular, and we'll get into that shortly. But big week for you as well.
Yeah, absolutely. Very, very busy. Lots happening. So it's great to get into, I was going to say the beginning of the year, but it's the beginning of the second quarter already.
It's the beginning of the financial year. Close enough.
Absolutely.
And joining Miles, making his FinTech Insider debut, we have Jeff Charles, Head of Product at Ramp. Welcome to the show, Jeff. How are you?
Good. Thanks for having me here, Sarah.
You've also had an exciting few weeks at Ramp, but we're going to dig into that now. So let's get started. So the story is that 2-year-old Ramp has joined the FinTech Unicorn Club. So Ramp, which is a corporate credit card startup, has confirmed $115 million in new funding from D1 Capital Partners and Stripe. The round brings the total venture and debt financing raised by Ramp to $320 million and raises its valuation to $1.6 billion, making it a unicorn. Ramp's USP includes the deployment of card usage analytics designed to help companies identify wasteful spending. Over the past 6 months, transaction volume on Ramp has grown by approximately 400%, with a third of Ramp customers switching over from American Express and more than 90% of customers adopting Ramp as a comprehensive spend management platform, replacing Expensify, Concur, or manual alternatives, by which I think they mean spreadsheets. Jeff, obviously going to come to you first on this. Congratulations on the new round. Did I get all that right? And what are you going to do with this funding? Can you tell us a bit more about it?
Thanks, Sarah. You got it perfectly right. Great summary of what we're about. It's a convoluted space with a lot of different players and different tools. So I think you did great. And how I would summarize it is we're the only credit card and spend management tool that helps companies spend less. And we kind of anchor back to that goal around aligning incentives between the corporate card provider, the software, and the finance teams to grow companies more sustainably. So in terms of how we're going to use the capital, we're really going to invest in our R&D resources. So we are a product-driven, engineering-driven culture. And it turns out that software engineers in the United States, especially brilliant ones, are quite expensive to hire and retain. So we are going to heavily invest in bringing great minds to continue to push the technology aspect of our product and the user experience of it. We're also going to heavily invest in our go-to-market functions. So hiring more sales folks, account managers, and partnerships, and going super deep with other financial partners in the ecosystem.
That sounds really exciting. And just, a further question on that. I noticed that Stripe is one of your new investors. I mean, what's that like? Is that really exciting for you to have Stripe come on board, given, the success they've had, and again, particularly recently when it comes to raising money? They know a thing or two about that.
We're super excited to be working with Stripe. Obviously, it's kind of a match made in heaven. Stripe is a extremely product-driven and engineering-driven company that cares a lot about the technology they're building and the user experience that they're building and rebuilding it the right way. So we couldn't really think of a better partner through that. As you think about Stripe, they're focused on increasing the GDP of the internet, and we are going to be hooking up to that vision, really focusing on finance teams and really leveraging their technology. So I'm super, super excited to have them now investors in Ramp so that we align incentives and kind of go to market together, and the sky's the limit in terms of that.
Yeah, it's as you say, it's a match made in heaven. And I think the interesting thing is that both of you are looking to serve the sort of the small business space. And I think that is a space that sort of, well, obviously Stripe serves a lot of people, but they do help small businesses in particular, particularly over the last 12 months. And I think, that's an area that we've seen a huge amount of activity in, particularly over the last 12 months, a lot of investment coming in, a lot of new products. I mean, opening up to the wider group, why do you think that's happening now? Why do you think there's this sudden upsurge in investment in financial tools for small businesses? I don't know who wants to go first on that. Miles, do you want to go first, and then Simon, I'll come to you?
Yeah, I think answering the precise question about why now, I think that's a really challenging one, but we're seeing lots of similar themes. And so you've talked about it a lot on this show, the Capability and Innovation Fund, which we're part of, and we're investing the grant that we got from that, particularly in SME capabilities around payments access and payment services. So I think there's been a massive underinvestment over the years and lack of focus on SMEs, which maybe that's just coming to a head now, and therefore the corner, starting to turn the corner, and therefore great businesses like you're talking about are starting to see the opportunity come to fruition. And it's something that I particularly have an affinity with, having started a business back in 2008 called Corporate Pay that was doing similar things, and we were perhaps too early for the market, and I just don't think that we were at the right time. But now it's great to see all of this coming to market in a fantastic way.
Yeah, I mean, and maybe not the right time for that product then, but you've not exactly sat on your laurels since, so it's great to see the space finally being served. Simon, you had a point you wanted to make.
Yeah, I think just generally the sort of growth business sector was generally woefully underserved. And we saw Brex, and we've seen many others come into the space over the past couple of years. We saw TeamPay and Airbase, and there's lots of folks trying to solve for that space. But I'm interested in some of the cultural aspects of what you've built, Jeff. I mean, you guys built expense integration into Slack. It's the kind of thing that I imagine a large bank would never think of. But why do you think those things really matter to your users and make a difference?
It's a great question, Simon. Yeah, I think that so fintech has focused like a lot on the consumer side of things and building incredible consumer fintech apps, and then the attention has shifted a little bit towards like, well, small business owners or CEOs are consumers, and when they're thinking about their spend in organizations, they're thinking about their money as well. And so the founders of Ramp came from they started a company called Paribus to help individuals save money automatically. And they're bringing kind of that savings aspect to the founder persona, to the CFO persona, the VP of finance, the controllers, et cetera. And we're seeing a huge alignment in terms of that incentive. So I think that to answer your question, Sarah, the fact that there's so much attention in this space is because there's a movement that happened in consumer that's bringing into the small business space. And it's much easier now to compete against large financial institutions like Amex with the arrival of APIs, of platforms, and essentially enable to spin up a lot of different types of financial services. And so our approach culturally is to think about delight and think about automation in every single thing that we do. We don't try to replicate everything, but for example, we want to meet the finance person where they're at. So that's why, for instance, Slack was a great one. We saw that a lot of spend on our card was Slack subscriptions, and we said, okay, well, if that's the case, and if people are answering Slack messages and approving expenses, why not put it directly into Slack? So a lot of it is thinking and listening to users, which banks are poor at doing because they don't necessarily have that muscle or the attention span.
I think that's a point as well, that the M, so SMBs are generally underserved, but it's the M's, to Simon's point, the kind of the ones that have gotten out of the one person band, the two people in a garage space, and going into that, okay, we've got 10 people, we've got 20 people, we've got 30 people, and they're just even more underserved than the one person bands, if that makes sense. I think it's that's kind of where we're seeing a lot of this growth. You're nodding at me. clearly you agree. I was going to say, was that what you set out? Was that the audience you set out to target, that particular niche, or did that kind of evolve as those being the people who were most in need of your services?
When we launched, we had no go-to-market strategy. We just launched our product, and we saw where it resonated, and part of that is kind of testing. Walking in a dark room with a flashlight, and the traction that we've been seeing. I'll kind of give a perfect example of one of the customers saying this. That he had this picture of someone walking down the aisle saying, "Who's got the Amex? I need to pay this vendor," right? And that moment, that friction was like, you're using plastic cards instead of virtual cards. You're using one plastic card across the organization because Amex underwrote the business owner, who is liable for paying them back. And people need to share this plastic card to make payments. And they have no idea who's spending on it, why they're spending on it, and they have no idea, where the receipt is. So that was like the magical moment. And that typically happens, to your point, Sarah, when you hit, 10-ish employees, like that friction. But the friction keeps going. I mean, then it's around approvals and PO and AP and all of that. And so we found that product market fit in that middle section, built a tool that it also enables CFOs and even CEOs early on to adopt. And then we're expanding into more of the mid-market segment.
I think that has actually happened at 11FS in the early days. I think I was employee number 30, and the one Amex belonged to our CEO, David, and he'd wander around going, "Has anybody seen my Amex?" And it was his Amex that had been passed around to pay for a flight or something. Simon, you wanted to jump in there.
And that Amex was tracked inside of our Xero accounting package, funnily enough, as well. So the weird things that you have to do when you're that size of business. And I do think this is the value left on the table by the incumbent banks of all of these problem spaces if you've never been in a growing business. I love the fact that your roadmap is almost exclusively things that somebody thought of in a bank but never did because they couldn't prioritize it, or the business case didn't make sense. But the business case for great product, the business case for solving customer problems has never been greater in this pandemic world. I'm curious as to what's next. I mean, you guys have a ton of momentum. I don't know if you have any figures that you want to share in terms of your momentum and growth, but where does this go for you now, Jeff?
Yeah, I mean, I think percentages is kind of an easy way to talk about growth, especially if you're a small company and growing fast. I mean, we're seeing double-digit growth every month, and doing well. And obviously, these funding announcements help there as well. I think that the focus for us is going to continue identifying pain and solving pain. And I think, Simon, to your point around it's hard to prioritize software. Banks see credit cards and software as two separate things. And they've tried to force a consumer-like product like a credit card into the business space completely wrong. And so we really think that our wedge is the card, but our strength is the software, and that real-time reconciliation is something that only we can provide. It won't be provided with something syncing to a Concur or a Xero. And so we're continuously exploring how far can we get with this embedded experience. So I'll give you an example, right? How do we codify a company's expense policy so that once they swipe their card, it automatically declines anything that's out of policy? So lunch on weekends or taxis before 9 p.m., right? Those are things that are now possible with the technology we're building. And furthermore, how do we expand into not just the card space? We are seeing a very strong growth in terms of the virtual card adoption of B2B payments, which we're writing, but there's still a ton to do in terms of ACH and check and disrupting that space. And then finally, as COVID kind of hopefully leaves us, or society kind of comes back to somewhat of a normal, although I'm sure it'll always be forever different. What does travel look like, and how do we essentially align incentives of individuals to be responsible with regards to the travels that they book and within policies? And so there's a lot of interesting things there that we can also do with card authorization around saving people money, around negotiating, around doing price drop guarantees, et cetera. So there's a lot of exciting things that we're exploring there.
Well, we really look forward to hearing more about them as they happen. But for now, we're going to move on to the next story, which is that Modular has received strategic investment from the venture arm of FIS. So Payments as a Service provider Modular has secured new investment from FIS Ventures. FIS plans to leverage Modular's API-based payments infrastructure to facilitate and automate real-time business-to-business payments in the UK and Europe as part of FIS's broader real-time payment strategy. Modular is tapping into the massive business-to-business payments digitization opportunity by working with software platforms that serve small and medium-sized businesses. Right on topic. Asif Ramji, I hope that's pronounced correctly, Chief Growth Officer at FIS, comments, working with Modular will be able to help our clients in the UK and EEA markets accelerate their journey to digital payments, as well as work towards delivering a suite of new global real-time payment propositions. Miles, obviously coming to you first on this one. First of all, can you give us a quick overview of what Modular is? What does payments as a service mean sort of tangibly as far as you're concerned?
Yeah, sure. And it can mean many different things to many different people, but I'll try and sort of set some context of what we mean by it. So we think of it as we're a payments platform, and we enable our clients and partners to integrate payments into their software, their business platforms to broadly do three things. Automate, control existing payment flows, so it can be receivables, payables, etc. Secondly, embed payments in customer journeys, and that's typically our partners. A whole raft of partners around payroll, accounting software, etc. And thirdly, enabling our clients or partners to build new propositions, so building on us as the, if you like, the infrastructure or the tech behind the tech. And we're doing that across a growing number of clients and names that people would recognize, such as Intuit QuickBooks and Sage and Revolut. So that's how we think about payments as a service.
And what are you going to do next then? Because that sounds like quite a lot to be getting on with. But with this new funding and obviously with FIS being a strategic partner, obviously there's a little bit more to it than just giving you the money and saying off you go. So you spend that on what you like. What are the plans for yourself and for working with FIS?
Yeah, it's really, as you said, I mean, money is always good and important and helps us invest in the business and growing it. But really using that strategic partnership to continue to really the themes that we've set out for growth for this year, and firstly going broader and deeper in existing markets. And so we started in the UK and in particular market verticals and going deeper into those. And the broader part is identifying new market verticals. So we found particular use cases and product market fit in payroll and accounting software, in travel, subject obviously to the volume coming back, and areas like property management as well. So going deeper into those, delivering more capability, more functionality, but identifying new sectors. And then another big area for us is we've largely been UK focused, and we made the strategic decision to go deep in the UK. So really build out a comprehensive payment platform, delivering many different payment types, getting things like direct access. So one of the few non-bank providers with direct access to the Bank of England. Except there's many examples of that. And we've started supporting our clients and partners that we acquired here in Europe. And we've sort of put that on obviously a firm foundation post Brexit with an equivalent license with the Central Bank of Ireland. And so now a big part of this year is now going deeper on the European payment stack and also starting to expand out into Europe as well. So I think that's going to keep us busy in 2021 and then work out what we start to do for further expansion after this year.
And I guess, interestingly, and perhaps Jeff can speak to this as well, I wonder if, given the space that both of you are operating in, Miles, particularly as you look at the business-to-business payment space, business-to-business payments have sort of historically lagged behind. We sort of covered that a little bit when we were talking to Jeff about how these kind of business services or services, particularly for those smaller businesses, have been underserved. Do you think that the events of the last 12, maybe 14 months now have accelerated the need for the products and services that you offer? Has it this, I hate to say drive towards digital, but you know what I mean, the kind of the forcing of the hand, I suppose, to update some of those services and systems that perhaps people have previously just gone, oh, it works, it's fine. Is that something you've seen, and do you think that that's had a big impact?
Yeah, we've seen it from some really practical, what you might think of small examples, such as for example, with some of our accounting software integrations with accountancy firms, previously, before using our services, they'd have to be in an office to manage and pay payroll. And clearly they couldn't do that through the last year. So actually having a fully automated solution that you could use that's all integrated and hosted in the cloud has enabled them to do that. And they haven't had to worry about it. So there's some real practical examples down to a business that's just paying 20, 30 employees, which is really, really good, through to, I think it's crystallizing or encouraging or maybe even forcing people to make decisions in larger organizations about what do they do about the digital transformation and saying, actually, yeah, we do need to get onto it. So a different dynamic to what you'd see in the, I guess, consumer world and changing behavior, but people now saying, yeah, I do need to get on with those decisions, which has been good for the B2B market.
Jeff, did you want to comment on that as well, as I'm sure you have an opinion, and maybe different in the US, but the pandemic has still had an impact there?
Yeah, I mean, I agree with everything Miles said. If you think about check payments, which need to die, it's the technology that just keeps on giving. But when you're paying a business with a check, they receive the check in their office and they cash the check. I mean, that doesn't happen anymore, right? No one's in the office checking the mail. And so it is definitely accelerating the trends. Furthermore, I think procurement looks different now. I mean, you have different individuals who are now at their homes, and we've seen a proliferation of SaaS tools just in general across businesses. I mean, you have everyone's either on Zoom, but there's a ton of different collaboration tools, and all of which need to be moved in the cloud because now you're working cross-functionally in the cloud. And so there's a lot of SaaS spend, and that SaaS spend is now being done via virtual cards and digital payments. And I think that is only going to become increasingly important as people see the value of real-time reconciliation of strong L3, L4 data on Visa networks or MasterCard networks. And I think that's only going to become increasingly important.
Yeah, no, absolutely. Sorry, Simon, were you waving at me, or were you just... No,
I was listening along intently, but I do think it's a great point about how once you've got access to the data, Jeff, you can do much better things with it. And Miles, once you've got great APIs as a builder, you can start to create the company you want to create rather than sort of dealing with the infrastructure that you happen to have received or the software you happen to have used. And I'm interested as you look at the market. It's going to be an interesting couple of years for Europe. I think the US has got Stripe that's done a lot with issuing now, and you've had the guys like Synapse out there for quite some time. We've had some players in Europe like Railsbank and yourself, but it's all been sort of quite geographically limited. So as you look into Europe, what are your priorities as you start to think about expanding, and what do you think the value is going to be for the non-UK based clients in the short term?
And I just want to add to that question, how difficult is it? How much more difficult is it to do it cross-border?
Yeah, I think it's a big challenge, which is why we've been very focused on making sure we had a firm base here and got to some sense of scale. I hesitate to say to scale because we believe there's so much opportunity still to go. But I think firstly that point you make, Simon, I just really love that, because it's why we started the business around the software you get given, or the integration you get given, or you're made to feel lucky that you were given that access by a bank versus actually giving something people would like. And that was our experience in the previous business I mentioned, that we fought, you had to fight to almost get access. And then when you had it, you were given it in a way they wanted versus the way you wanted and could build a business. That's really the core hypothesis of why we exist. But to answer your question about the European expansion, it's why we have started and focused on the UK, and it's why the next step we're looking at markets that have commonalities across Europe, so we can operate on a pan-European basis initially. So financial services and travel are good examples where there are those commonalities. And then what we're trying to do next is look at where we have specialised in the UK, for example, in payroll. The learnings there of how we specialise, what we've learned, not how we replicate those in Europe, because clearly they're very different. So managing payroll in France is very different to managing payroll in the UK. But what questions do we need to ask? What type of distributors do we need? What sort of partnerships do we need? And approaching it in that way. So we're trying to be particularly thoughtful about it and where we go about it. But as you say, there's a big opportunity, and it's very early stage, but it is very different. It has I think we have the benefit of being able to passport now from Ireland across Europe, but there's the region or the country differences that we need to be very aware of.
And just before we wrap up this section, that's something, Miles, that we talk about a lot on this show, is that people think, oh, it's Europe, everything, it's all the same, and it's so not. It's so different culturally. I mean, I just wonder, Jeff, if you had anything to add to that about when we're talking about expansion and how you approach it.
I mean, there's a huge advantage about being in the U.S., right? We have 300 million people; they all speak the same language, more or less, and there's very little regulatory overhead. Apart from maybe small dollar lending, that is statewide. So that's why there's a lot of unicorns very fast in the United States. It is a competitive advantage of us being a larger country with a higher TAM that doesn't necessarily need strong regulatory cross-border and compliance. And so we are very thankful to have 32 million businesses in the United States that can be customers of Ramp. And there's plenty of runway there. So not really exploring expanding internationally yet. There's a lot of lookalikes across the world, and we do wish them best, and we advise them. I think it's great to keep that network going, and ultimately we'll expand when we hit our mark. But I think the opportunity in front of us in the United States is unprecedented.
Oh, absolutely. And I think that's something that, is one of the obvious differences between operating in Europe or with even one country within Europe and the US. But for both of you, we look forward to seeing your next steps and your expansion plans wherever they may be. But for now, we're going to take a quick pause. We'll be back very shortly. 11FS is supported by Banking Circle. Connect to the fastest, most cost-efficient and transparent payment solution available in the market. Our brand new podcast is here. In Under the Hood, we lift the lid on the banking infrastructure that's shaking up the financial services industry. In partnership with Synapse, we'll explore a different area of banking tech every Thursday and talk to experts around the world. Head to your favorite podcast app and follow Under the Hood to catch the latest episode. Okay, welcome back. Our first story this half is that China has created its own digital currency. So China's version of a digital currency will be controlled by its central bank, which will issue the new electronic money. It's expected to give China's government vast new tools to monitor both its economy and its people. By design, the digital yuan will negate one of Bitcoin's major draws, anonymity for the user. The People's Bank of China has said the central bank will limit how it tracks individuals, in what it calls controllable anonymity. Beijing is also positioning the digital yuan for international use and designing it to be untethered to the global financial system. Okay, Simon, you know an awful lot more about crypto and digital coins than I do, so please kick us off on this one. What can you tell us about it? What does it mean? Does it have wider implications?
Yeah, it's always hard observing China from outside of China because you have this horrible habit of seeming remarkably uncultured because it looks very different when you're there than when you're inside it. But the key thing here is, as a central bank digital currency is very different to the digital currencies out in the wild. In other words, much like the coins and notes in your pocket that are printed on a printing press somewhere, this is a central bank doing the same thing, but with digital coins that would sit in a digital wallet. And it's a little bit different to a bank account. So in a bank account, there's actually a database somewhere in which a bank is storing a record of my balance. This is a little bit different. The money actually moves between different wallets, different phones, different devices. So it feels a lot more like cash. So for China, there's a number of obvious benefits in the short term. They see some real practical benefits in terms of, that you've got some very large payment mechanisms in Ali and WeChat that maybe are a little bit too big, a little bit concerning. And you see similar things happening with competition concerns in Europe and people worried about Facebook Libra. There's absolutely some sense to that. So they're trying to make things like everyday bill payments easier. They're trying to do things like financial inclusion. But the domestic aims aren't really the key for me in China's central bank digital currency. Actually, if you look at China, much like a lot of Europe, it is subject to what is frankly the US dollar global system. And if you had another way of moving money around the world across border that was digital, that competed with the old world of financial services that uses SWIFT and uses the dollar and uses the banking system, maybe when you're dealing with Africa, when you're dealing with Europe, when you're dealing with the rest of Asia, this would be a really good geopolitical advantage and a way to move money around the world that's frictionless, but also gives some policy control. So there's some questions there about, is it a threat to the dollar? And is this why people are now talking about central bank digital currency? So lots to think about there, lots to unpack. But there's the domestic piece of it, and then there's the international piece.
How might it work internationally? This is me being stupid. I don't fully understand this area very much at all. But how would you, if you had a digital yuan, where would you send it? Would it have to be sent to a wallet that somebody in another country had that was set up to accept that? And is that how it would work, or?
Yeah, I believe that's what they're envisioning. And there's the consumer element of it, and then there's the institutional element of it as well. So it essentially becomes another payment rail. It starts to almost look a bit like PayPal in the early days. You take your regular old currency, and now you're inside of this system. You can transact with anybody inside of this system. But actually, if I'm going to do a very large deal with small African country, small country at another part of the world, then I would potentially want them to use and incentivize them to use this payment mechanism because it's in my interest. So there's a lot still to be worked out. They're still very much trialing it. It's still very much academic. I think there's 200,000 users, which for China's scale is very, very small. But we'll see if that takes off. So I think that's the current thinking, but that could still change. They've put lots of papers out about a tiered system as well, where it could run through the banks, and they get wallets and you control them through different apps. That way it could still work with the big tech companies. They're still finding their feet, which is why I think it's confusing.
Yeah, absolutely. And it sounds like they're one of the first people to get this far with this, unless I've misunderstood other organizations and countries' experiments with central bank issue digital currencies. Simon, you're going to correct me on that?
No, you're absolutely correct. The only thing I'd say is there are obviously other stable coins in the wild that are not issued by a central bank. So I think about Tether, USDT. I think about USDC, the US dollar coin coming from Coinbase and Circle. There are ways to move money around the world that feel almost frictionless, that feel digital, that are not issued by a central bank. That's going to be quite interesting to watch because you've got this Chinese central top-down model. The European Central Bank is trying to develop a digital euro. The US actually has a bit of a history of co-opting the private market. So if you think about Visa and MasterCard, especially Visa, it's low-key a bit of an arm of the state. You regulate it into existence, into legitimacy, and actually you can start to manage that through the rest of the world. Will we start to see the market solve it in the US in a way that maybe China wouldn't go for?
Yeah, that's interesting. We, as you say, we see a lot of innovation sold by the market in the US, which is sold by regulation elsewhere. I think open banking and open finance is another one. Jeff, you were nodding along there with a lot of what Simon had to say. What are your thoughts on this?
Maybe it's actually a question for Simon. Like when I hear about a government-controlled cryptocurrency, how is that different than the yen itself? I mean, when you think about like if they can manage production of these coins, how is that different than printing, right? Like the value of crypto or things like Bitcoin is that there is a finite supply, so you're not at risk from any monetary policy or inflation, and it is a storage of value that is much more efficient than the gold standard or any type of a printing press. And so I'm curious, like, how this is any different, and if so, realistically, this move is simply true to potentially, improve their stance in the world. I mean, ultimately, like the reason why the yen isn't the standard for how money is exchanged is to the advantage of the Chinese government, so that they are constantly, cheaper than the US dollar to be able to have a strong influx in terms of their trade agreements. So there is like a lot of politics involved there. But I'm curious, Simon, like how would this be any different than what happens today? And is this just an oversight on our part?
No, not at all. I think it would look and feel very similar for most users in most use cases. So I think you're spot on. The Swedish central bank, the Riksbank, did a really good paper in the last week or so where they looked at the material benefits of actually doing it. And one of the major ones was simply offline transactions. If you have no network connectivity, if you're in rural China, which is still quite a large percentage of the population, those offline transactions continue to work in this more decentralized model and can continue to be effective. When you have local authorities that have to deal with local people and you are trying to push cash out of the system, which is subject to a lot of crime, which is subject to a lot of fraud, this actually gives you an ability to trace what's happening in the system. Now, that sounds really scary from an anonymity standpoint, but the other side of being able to see what's happening in the system is you can set policy around financial inclusion. So for every negative, there's also a positive. Like imagine if I had the data about what was happening in the system, how money was moving through the system, I can start to do interesting things with policy from there. So I do think there are some pros for it, but you have to consider who they are and what they want to achieve versus who wrote the Bitcoin white paper and what they wanted to achieve. It is clearly a different use case, clearly a different set of benefits.
All right. Well, I think that's going to be one that we're definitely going to have to watch and learn from. It sounds like it's, as we said, it's one of the early movers. So there's a lot to be learned from it. I think also to Simon's point, looking at China from the outside in can always seem a little bit puzzling. And so we need to wait and see what comes out of it. Okay, on to our next story. And I'm not sure I'm happy about reading out this headline, but I will do so anyway, and then we will discuss it. Mortgages suddenly sexy as SoftBank pumps $500 million into Better.com at a $6 billion valuation. So Better.com is a digital mortgage provider. It's raised the $500 million round from SoftBank. The new valuation is up 50% from the $4 billion it was valued at last November when it raised $200 million in a Series D financing. The investment brings Better.com's total funding raised to over $900 million since its 2014 inception. The COVID-19 pandemic, historically low mortgage rates, and the general fervour in venture funding has been credited with the appetite for this new funding round. Okay, does anybody think mortgages are ever going to be sexy? Let's just start with that, or is this just a step too far?
I'm all for them. Having just bought a house, I could really do with that. And my short take on this one is during the pandemic, branches were closed. Most people were still buying mortgages through some analog channel. To have something that was entirely digital just makes a ton of sense. And every bank has been trying to shift to being 100% straight through digital processing on mortgages. And Better.com has been leading the way on that for quite some time. But I always think about there's so much more to it than getting the mortgage. There's the whole being able to save up for your deposit. There's figuring out where you're going to live. There's managing moving day. There's dealing with the lawyers, the realtor, everybody involved, the utility switching. There's just so much pain around the move that I think these folks like this are actually really well set up to add value well beyond just making a mortgage frictionless. And I think that maybe that's what they're seeing here.
I think the interesting thing about Better.com as well is that it's actually the lender, whereas a lot of the innovation we've seen so far in the UK around mortgages they've been digital brokers, which are great, but they haven't done much of the lending themselves, apart from Habito. And Habito, I would say, is one of the leaders in the mortgage market, digital mortgage market in the UK. So they have those value-added services. They have Habito Plus, which is brilliant. I've actually used it myself. And you get a person who does all the liaising for you. They speak to the solicitor and the surveyor, and they ask all those difficult questions that you might be too nervous to do yourself. And then, of course, they've brought out their own underwritten mortgages in the last few months as well. So I think the point being that mortgages are hugely ripe for disruption, but they seem an awful long way behind. I mean, Jeff, am I right in saying that perhaps this digital journey is digital mortgages are slightly further ahead in the US, or is it's still something that's incredibly traumatic and nobody ever wants to go through it again?
I think for anyone not on Better, it's probably a very traumatic experience. There's a reason why closing costs on homes are like 10 to 20% of the housing costs, and that's the inefficiency in the system, right? The person doing the analysis of the house, the insurance, the leases, the agreements, the signatures, all these things, and so. I know as a customer of Better and actually a friend of some of the folks that work there, they're really digitizing the entire process and removing a ton of friction. And I think that they're riding the wave in terms of the digitization. They're riding the wave in terms of the fact that more people are buying homes now. We've all sit in our homes, in our tiny apartments in New York City where I am, and looking at the nice homes in Pennsylvania that are much more cheap, and the fact that now you can work wherever you want, and that might actually be a trend that continues given the efficiencies that most companies have seen, at least for workers that can work from home, that are privileged enough. So there's a trend here, and I think they're riding it really well.
You're actually entitled to give that testimony as well as a Better customer. I didn't realize you were before I asked the question, so that's really good to hear. And Miles, what are your thoughts on this? I mean, do you think that mortgages are the next big area to be disrupted? Do you think they're ripe for disruption?
It's not a market that I know particularly well, but some thoughts that I see some parallels to what we've seen in the payments industry and what we were talking about earlier around sort of infrastructure. And it sort of makes me wonder when you look at the main mortgage providers in the UK. So really down into the traditional building societies. Do they have access to the infrastructure that enables them to change this? And therefore, will there be providers out there that can help them go through that change to make it happen and take the friction out of the process? We're seeing there's a business in one of our investors' portfolio called Kudu, who are looking at it from that perspective, of how they actually enable those existing institutions change the journey. So maybe that's a different sort of angle on the market, similar to what we're seeing from a payments infrastructure point of view in that market as well. I think that's going to go through a lot of change, and perhaps there's a nice coming together of some of the payments as a service, and maybe there's a mortgage system as a service.
That is something that we've actually seen. There's a company over in Australia that does it, and I can't remember off the top of my head, but Simon, you probably have another example.
Yeah, Blend.com is the obvious example. They've been hugely successful. And then there's obviously Amount.com. They work with like traditional lenders, and they're the vertically integrated SaaS that takes care of all of the KYC, all of the documentation, all of the underwriting. They have this thing called Lender Copilot, which is talk in real time. And if you've just had all of your branches closed and you can't do any mortgage business, this verticalized SaaS that can take care of all of that for you is really, really good. The one thing I talk about when I'm talking to senior executives, though, is be careful giving all of your technology real estate to one supplier. Like, think about how you're going to have software optionality. I mean, to Jeff's point earlier, I think the future of fintech and finance is that really good marrying of like really good product and really good software engineering. And if you're not able to build that discipline, then this is a good kind of sticking plaster, but you're going to have to build that skill at some point, I think, to really differentiate for your customers.
Yeah, I think it's exactly to your point. I think it's this back end space that needs completely rethinking, and everything that goes along with that. To Jeff, to your point, culture, but also processes. Rethinking how you actually what does a mortgage look like? Why do we have all these steps, particularly in the UK? Why am I paying that person that much money to sign that piece of paper? That doesn't make any sense. All these archaic processes that need to be pulled back, and then it makes all that digitalization so much easier. I just wanted to get people's thoughts on SoftBank perhaps here, because SoftBank hasn't had a great reputation or media representation, perhaps would be fairer, in the last few months. I mean, would you still take money from SoftBank? is it still making good bets? What do you think? I mean, I may be leading you there, but I just thought it's interesting to see them continuing to pump money into companies, I guess. So
As the one that's not recently raised or about to raise, I think I'm happy to maybe have a go at this, because I felt Jeff and Miles like,
money's always good. Money's always good.
I think money's good, but obviously with WeWork and a few other things, they got some bad press. But with what's going on with Grab now and the SPAC, and with an investment in Oak North, who's one of the more sturdy fintechs and one of the more well-known and profitable, this is always something that generates headlines, sometimes a little bit controversial, but actually this feels like if you're going to bet on something, Better.com does feel like just a really good house in a really nice area as fintech goes. I know that sounds crazy to think about, that there's a more conservative investment in fintech right now, given how hot this space is, but they feel like one of those. So I don't know. I think SoftBank gets a bit of a bad rep personally. They definitely have their moments, but people like the drama and forget about some of the wins, I think, too easily.
I think that's fair. And I think also, all the things that happened with WeWork. Well, WeWork, maybe had some issues before the pandemic, but the pandemic was not anybody's fault, which has caused WeWork an awful lot of its woes of late. Miles, Jeff, do you want to add anything else to that? SoftBank or aside, or is there anything else you think that we've missed on this idea of like digital mortgages and what you'd like to see perhaps?
Yeah, I won't comment too much on SoftBank. Got a lot of friends there and a lot of respect for the firm. They have a different philosophy, right? Their philosophy is, if I inject a lot of capital in this business, can I help it get 10x, right? And there is a question around which businesses can ingest that much capital. If you gave Ramp, $500 million, what would we do with that? And I think there are companies that can do good things, and there are companies that can't do bad things. And I think SoftBank has had a hit or miss sometimes in finding which companies can. I think the way that we think about funding is we think about strategic partnerships. And so, the round that we raised, there was a ton of players in that round. And part of that was that each of these players were so essential in one part of our product or distribution or strategy, and bringing people in, less than having one huge player, but a lot of small players actually creates a lot of incentives, especially in a space where everyone can win. So that's really our investment philosophy. And I think, Eric and Kareem, our CEO and CTO, have done an incredible job building those relationships, and we're excited about it.
I think we're seeing actually a much more of a move towards that as well, or certainly there's been a lot of talk about it, about brands choosing their investors for the advantages they can bring, not the advantages they say they can bring, because every investor would say, oh, we can do A, B, C, D, E and promise you the world, but actually thinking a lot more carefully about who you take money from and how they can help you beyond the funding. I think that's a trend that we're definitely going to see continue. Miles, do you have a final word on this, or shall I?
Not much other than saying I completely agree that achieving that and getting that alignment and being very careful and considered about it is super important.
Okay, I think that's something that we will keep an eye on, and I'm sure it will come back. I'll be proven right or wrong, won't I, in 6 months' time? So I'm sure somebody will hold me to task over it. Okay, we are now getting towards the end of the show, and we're going to round up some of the other stories from the week that we didn't have time to cover today, but we think still deserve a shout out. So Simon, over to you first.
Yeah, first one is from Finextra, and this is MasterCard unveiling a carbon calculator for banks. So they've teamed up with Swedish fintech Deconomy to develop a carbon calculator that banks can integrate into their apps to give customers a snapshot of the emissions generated by their purchases across different spend categories. A MasterCard commissioned survey of more than 25,000 people from 24 countries shows that 54% of respondents see reducing their carbon footprint as more important now. 58% have become more conscious about how their actions impact the environment than ever before, and Gen Z and millennials, 65%, of course, lead this trend. This is good. Generally, let's try and save the planet. Let's not be the last generation on it. Let's leave it better than we found it. I do think that as I look at this, prefabbed products for banks to stick inside their apps is an interesting way to go if you're a MasterCard or a Visa, and partnering with fintechs just makes a ton of sense for that. So I think that's actually the trend that I take away from this, as much as just how important it is to embed impact with everyday spend. And we've seen banks like Aspiration in the US and Tomorrow Bank in Europe and many, many others start to really think about how do you connect your everyday activity, your everyday spend to your carbon impact. And there could be a lot of opportunity there. And last word on this is, as I sit back and I look at the amount of profit that banks throw off, they're struggling to grow their top line, their costs are continuing to increase, they're very much seen as a yield stock, and that profit is all going back to shareholders. Actually, what if some of that profit was directed differently at things like this? And maybe what impact could that have for the world? So a little bit of hope for the future, who knows?
Fingers crossed. Next story is that Trustly is seeking a $9 billion... God, no, it's not. Trustly is seeking a €9 billion valuation on IPO. So Swedish payment firm Trustly has confirmed plans for an IPO that could value the company at up to €9 billion. The company will sell shares worth €785 million, part of which will be used to redeem preference shares and repay debt. Like other payments processes in Europe, Trustly is riding a wave of investor interest as the coronavirus pandemic has pushed more transactions online. The firm's most recent funding round, which was led by BlackRock in June of last year, commanded a price tag of about €2 billion. This is going to be a really interesting one because Trustly is one of those companies that does a lot of work on account-to-account payments, so it cuts out the middle person, if you like, the Visas and the MasterCards of this world, and it makes it easier for you to pay directly from your bank account, which potentially has a huge amount of advantages for consumers, for merchants, and it's a trend that we've been keeping an eye on, and one that open finance is going to make a lot easier for companies to enact if they want to do so. So I think how this IPO goes will be a real sort of test of how much appetite there is for kind of new payment mechanisms, particularly those that cut out the cards. And in Europe, that's going to be really fascinating to watch. So let's wait and see on that one.
Thank you, Sarah. Story from Finextra. Nubank are pumping funds into their Mexican unit. So Brazilian digital banking powerhouse Nubank is pumping more than $70 million into its Mexican subsidiary as it looks to expand its geographic reach. The company's identified Mexico as a prime target since launching a credit card in the country last March. New Mexico has seen more than 1.5 million people request one. With an injection of funds from its parent and Wall Street banks, the Mexican unit is also eyeing a move into debit cards, personal loans, insurance, and loyalty programs. Launched just 7 years ago, Nubank is already valued at $25 billion, with more than 30 million customers, making among the 5 most valuable financial institutions in Latin America. I mean, no surprise to see Nubank continue to execute. Incredibly talented team. They've done so well in Brazil, and frankly, just went into a market that just did not really cater for anybody but the wealthy from a banking perspective. And we talked earlier about how banks were sort of treating you as if you were lucky to take their product from them. In Brazil, that was exceptionally bad. They would make you wait outside of branches for 30 to 45 minutes. And just by having a good, slick digital product, Nubank made a massive difference and have really executed. And A16Z published this week that LATAM continues to be a massive opportunity as hundreds of millions of people that are still, really underbanked, and really good digital distribution is going to be a way forward. So not surprised to see this. Nubank could be just at the beginning of their growth spurt. So going to be one to watch for sure.
Yeah, absolutely. Nubank, I wrote recently about how Nubank is the digital bank or the neobank or the challenger bank, whatever you want, that everybody should be watching. It's absolutely fascinating what they've done and how well they've done it, more importantly. And speaking of terminology, our and finally story this week is that France's central bank threatens the fintech industry with 3 years imprisonment for misusing the term neobank. The Prudential Control and Resolution Authority, ACPR, presumably I've done the English translation there, which operates under the Banque de France, has stated that the term neobank must necessarily qualify a credit institution, so i.e. a licensed institution. The regulator is wary firms are misleading users on their actual status by wrongly qualifying their businesses as neobanks. Use of this word to qualify another activity other than that of a credit institution is prohibited by law, says the ACPR. It specifically calls out payment institutions and electronic money issuers as well as their agents and distributors. Those fintechs which continue to mislead customers into thinking they are a credit institution are punishable by 3 years imprisonment and a fine of €375,000. The regulator has not suggested an alternative term for firms to use. Potential alternatives are already in circulation, include digital challenger or digital banking startup. Now, I have mixed feelings on this because it really annoys me when non-licensed banks call themselves banks. I always call them account providers because I really don't think that you should be saying I'm a bank when you aren't licensed to hold that person's money. When you're licensed to move that person's money but somebody else is holding it, I don't think you should get to call yourself a bank. Do I think you should be sent to prison for 3 years for that? Probably not. I think there are other ways to enforce making sure that customers understand what kind of institution they're using. I think particularly in the UK, where obviously if you are depositing your money with a licensed bank, it's insured up to £85,000. And I know that in the US you have the federal deposit insurance that has a similar coverage on it. But I just don't necessarily think that imprisonment is the right threat. Anyway, that's my 2 cents. What does everybody else think on this one?
I want to know what else you could throw people into prison for that's a tiny crime. Like, it's startups that say they have lots of AI, but actually it's all just people behind the scenes. Could that be a crime?
Is it a tiny crime, though, if you say you're a bank, people give you loads of money, and then you lose their money and they're not insured, and all those people suffer?
Okay, maybe it's a big crime if you didn't get away with it, but there are things like this that just feel like it's a labeling thing. I don't know, that AI thing. I've just seen a lot of that lately, where it's like, look at our AI, and you look under the hood, and it's 2 people on a bicycle, and you're like, well, is it AI?
Or is it if that then is it, or is it if statements? Too many ifs.
From my point of view, it's a very interesting topic, and there's a lot that we could talk about here, and I think But to try and, I guess, sort of summarize it, I think there are a lot of inconsistencies, and I'd agree with Sarah from a point of view of people shouldn't describe themselves in a way that is incorrect and inaccurate and misleading. But I think also the moving on to the second part of it, the industry and the regulators have not caught up with innovation, and there are a number of parts there where I think it gets confusing because there are the good schemes like the Financial Services Compensation Scheme, there's the FDIC in the US, but we haven't found a way of really succinctly describing the protections that exist with other institutions as well. And we've got to find a way, or we've got to find a way of bringing them all in one scheme. Otherwise, as a consumer that quite rightly doesn't understand all of this, how on earth do you understand how you are protected? So I think there's that aspect, and I think as we go through it, I think the regulators should be better at managing the inconsistencies where people are using it where they shouldn't be, and should stop it. I think then in terms of how business models have moved forwards, how do we change it? How do we adapt it? Because it's like with the term bank account. People know what a bank account is, and then if you give them, as you quite rightly say, Sarah, an account or an account provider, a customer may still refer to it as a bank account because it has a sort code, it has an account number, or it has an IBAN. What do you call it? Because we've had that where customers say, well, it's not a bank account, it's one of these, and it does everything in this way. Oh, you mean a bank account? No, we can't call it that. So I think there's a need there for the industry, the regulators, to come together to solve this in a way that helps the end user.
Yeah, I mean, it's been particularly brought into stark relief in Europe with what happened to Wirecard and the impact that had on Wirecard's end users, many of whom thought that they had accounts, and then they had to listen to their provider explain to them that actually they didn't hold an account with their provider. It was a third party who had their money in Germany who'd suddenly gone bust. And that was a very complicated explanation that consumers just, A, weren't ready for, and B, didn't understand even when it was explained to them, I suppose is the point. Jeff, I'll give you the final word on this one.
I completely agree with what Mal said. I think this is a shortcut to thinking about the broader picture and the broader problem around disclosures to consumers and regulation when money is being fronted and moved around. I mean, when you think about Venmo in the United States, the money's not being held by Venmo, right? It's in an FDIC insured FBO Wells Fargo account, and those things are very clear. I think a lot of respect for the French government. I'm actually from France originally. You probably can't tell with the accent, but they have this classic, who are you protecting? Are you protecting the consumer, or are you protecting the banks themselves? And there's a lot of lobbyists that are coming from those national banks, and you see that all over the place. You see that with credit reporting and how it's completely dominated by those national banks, and you see that with the friction in terms of innovation in politics. So I do lean the other way, Sarah. And the one example that comes to mind is there was an FDA lawsuit around almond milk and the fact that you can't call it milk if it's not coming from cows. I say this because that was trying to protect dairy farmers, not consumers, right? And I think there's some parallels there around how absurd it is to focus on that rather than focus on the underlying problems.
Okay, yeah, no, that's a fair point, and I would just like to say that my concerns are for the users of these services, not for the banks who might be concerned about the neobanks chipping away at their business. All right, well, that wraps up this week's news show. Thank you so much to all of our guests. Where can people find out more about you? Jeff, we'll start with you.
Yeah, I mean, it's Jeff Charles on Twitter. I'm just starting off the career tweet storm. But just in general, ramp.com, very easy. Would love your feedback on our website, on our product. And if you have any thoughts on this space, please feel free to reach out on LinkedIn.
Brilliant. Miles, how about you?
Yes, so you can find us at modularfinance.com, drop the A from the modular. And I'm on LinkedIn, Miles C. Stevenson.
Perfect. And Simon?
You can find all things 11FS at 11FS.com, and you can find me at SYTaylor on Twitter, tweeting about all things fintech, always. Never stops.
And as for me, you can find me on Twitter at Sarah Kachansky. Thank you so much for listening. If you like what you've heard, subscribe to the podcast, and don't forget to leave us a review. It helps to make it better, and it helps others to find the show. As always, if you want to join the conversation, you can find us on social media. Just search for 11FS or Fintech Insider, or you can email podcasts@11FS.com. Thank you so much for listening. Goodbye.